Our next category of adjustments are referred to as unearned revenue adjustment. Perhaps you're saying, what is unearned revenue? This means that cash has been received before the revenue has been earned. Again, it means cash has been received before the revenue has actually been earned. So think about an airline ticket. If you're going to fly somewhere, normally we're going to buy our tickets maybe weeks or months in advance. For the airline industry, that's referred to an unearned revenue, which is a liability account. Because at this point in time, the service has not yet been performed, although we received cash. Or maybe you are season ticket holders for your favorite sports team, and you bought that season ticket again in advance for that particular sports organization. That is known as unearned revenue, which means that cash has been received before the revenue has been recognized or recorded. When we have these unearned revenue transactions, we're going to make what's called an adjusting entry at the end of the accounting period. The adjustment will show us what portion of the unearned revenue has been earned by the end of the accounting period. When you make the adjustment for the amount that's been earned, you're going to debit the liability account, which will be the unearned revenue account, and recognize an actual revenue account. So the purpose of the adjustment is to show what portion of the unearned revenue, a liability, has now become actual revenue by the end of the accounting period. So you make the adjustment, again, you're going to debit a liability account and you're going to credit a revenue account. For example, we have Pioneer Advertising received on October 2nd from a customer $1,200 for advertising services expected to be completed by December 31st. So they paid us in advance on October 1st an amount of $1,200 for work that we should be completed by December 31st. The unearned service revenue shows the balance of $1,200 on October 31st. Announcement reveals that the company performed services in the amount of $400. What this means is that by the end of October, we have earned a portion of that $1,200. We've earned $400 has been earned by October 31st. So we're going to make an adjusting entry on October 31st to show the amount that we've earned by the end of the accounting period. Once we've earned the revenue, we're going to decrease the liability account, unearned service revenue, and recognize service revenue. So notice it is the word unearned that makes this a liability account. Once it has been earned, we're going to credit an actual revenue account. So if I take a look at the ledger accounts for those two accounts, the liability account was $1,200, but now $400 has been earned. It has remaining balance in the amount of $800. And with the revenue account, the $400 earned will be added to our service revenue ledger account. Okay. Let's talk now about what's called accruals. Accrued revenue or accrued expenses. Accrued revenue means that the revenue for services has been performed but not recorded on the accounting records as of yet. So we've actually earned the revenue, but we have not recorded the transaction yet into our accounting system. When you have an accrued expense, it means the expense has already taken place. However, we have not paid the expense yet, nor has the expense been recorded. So at the end of the accounting period, we'll have to make adjustments for any accrued revenue transactions or accrued expense transactions. So with the accrued revenue, it simply means, again, recognize we're going to earn the revenue before we receive the actual cash payment. It's no different than your place of employment. Let's assume you went to work all this week, but you won't get compensated until the following week. For you, that's known as accrued revenue. The revenue has been earned, but the cash has not yet been received. So we're going to make an adjusting entry at the end of the accounting period. We're going to debit what's called a receivable account that will show and recognize the amount that's owed to the actual company. And since you performed the service already, we're going to credit our revenue account to show the amount that has been earned. So we're making the adjusting entry. We're going to debit an asset account or receivable account and credit a revenue account. For example, in October, Pioneer Advertising performed services worth $200 that were not billed to clients in October. So we're going to make an adjusting entry at the end of October to show the amount that we've actually earned by the end of that accounting period. We will debit the account receivable account in the amount of $200 to show what's owed to us, and then credit our service revenue account. Remember that you're able to recognize and record revenue once you have completed your performance service obligation. Therefore, the revenue can be recognized in October by the end of that accounting period. Now, they paid us in November, on the 10th of November. So once they pay us, what counts will be affected? You guessed it. Because they're paying us, our cash will increase by $200 and decrease the account receivable, which is an asset account. Notice that the revenue wasn't recognized when the cash was received, but when we perform our service obligation back in October. So for those two accounts, the account receivable account is showing the $200 before adjustment, and it's a revenue account for $200. Once the payment is received in November, we will also post those transactions to the appropriate ledger accounts. Okay? Again, accrued expenses or expenses that have already incurred or taken place, however, they have not yet been paid. So think about interest. When you have a debt that is interest bearing, car loan, mortgage, however, interest is going to accumulate. So we're going to recognize what is the amount that we owe in expenses by the end of the accounting period, and we then want to journalize and record that particular transaction. When you have an accrued expense adjustment, you're going to debit an expense account to recognize the expense. And because you haven't paid it yet, you still owe for it, you're going to credit and recognize an increase in your liability account. Okay? We have Pioneer Advertising signed a 3-month note payable in the amount of $5,000 on October the 1st. The note requires Pioneer to pay interest at an annual rate of 12%. Well, October 31st is the end of our accounting period. So our job is to recognize how much in interest has accrued on this note by the end of the current accounting period. So the formula, take the 5,000, 12% is the annual rate, take that times 1/12, because we're only looking for the time period for 1 month. So the accrued interest on this note by the end of October would equal $50. To make the adjustment entry, we're going to debit the expense account and credit a payable account for $50. That's to record the expense and show the amount that is owed in interest by the end of the current accounting period. Once again, after you make the journal entry, you would then post that transaction to the appropriate ledger account. Okay? One more if my battery goes dead. Pioneer pays salaries and wages to employees on October 26th. The next payment will not occur until the 9th of November. The employees are paid $2,000 total for a 5-day work week, or $4 per day. So we paid them on October 26th. The accounting period ends October 31st, and they're paid for a 5-day work week. So we owe them for Monday, Tuesday, and Wednesday. We owe them $4 per day. The amount owed will be $12 is amount owed by the end of the accounting period. So to make the adjustment entry, we would debit salary expense for the $12 and credit the liability account salary payable for the $1,200. The key is to recognize and record your revenue and expense transaction in the accounting period in which they actually incur. So we have to make these different types of adjusting entries at the end of the accounting period to make sure that all of our accounting records have been updated and that they are accurate. Okay? So make sure you read Chapter 3, look over our supplemental resource for Chapter 3, complete your Chapter 3 homework, and your Chapter 3 quiz and blog questions. Okay.